Welcome back, everyone. You've been sending in some really interesting stuff lately, and this time around, we're diving deep into income-generating assets.
Always exciting to see people looking for ways to make their money work for them.
Absolutely. We've got a lot to cover: dividend stocks, real estate, bonds, even dipping our toes into businesses and startups.
A pretty solid lineup. The sources you shared offer a really good starting point for getting a grasp on different asset classes.
And that's what we're here for, right? To break it all down and maybe uncover some hidden gems along the way.
Exactly. So where should we begin our deep dive?
Well, I've always been fascinated by dividend stocks. The idea that companies think Apple, ExxonMobil actually give you money just for owning their stock sounds almost too good to be true.
It does have a certain allure, doesn't it? Like you're getting rewarded simply for being a part owner of the company.
Right. So let's unpack this. What exactly are dividend stocks and what makes them tick?
In essence, a dividend stock is simply a share of a company that pays out a portion of its profits to shareholders. Think of it like this: when a company does well, instead of keeping all the earnings to themselves, they share a slice of the pie with their investors.
Okay, that makes sense. And that slice of the pie comes in the form of a dividend payment.
You got it. Now, the size of that slice, the dividend payout, can vary depending on the company and its financial performance.
So how do we know which companies are dishing out the biggest slices? What should we look for?
That's where dividend yield comes in. It's a percentage that tells you how much a company pays out in dividends each year relative to its stock price.
So a higher dividend yield equals bigger payouts, right?
Not so fast. While a higher yield might seem tempting, it's not always an indicator of a great investment. Sometimes, a really high yield can actually be a red flag.
Wait, really? Why is that? I thought a big dividend meant the company was doing well and sharing the wealth.
That's often the case, yes. But sometimes, a company might offer a high dividend to try and attract investors, even if their overall financial health isn't that strong. It's like putting lipstick on a pig, so to speak.
Ah, I see. So it's not just about chasing the highest yield, it's about looking at the bigger picture.
Exactly. You have to consider the company's overall financial stability, growth potential, and a whole host of other factors. It's like choosing between a seasoned marathon runner who paces themselves and a sprinter who goes all out but might burn out quickly.
I like that analogy. So if we're not just chasing the highest yield, what should we be looking for when evaluating dividend stocks?
That's where the real due diligence comes in. We need to dig into a company's financial statements, analyze their track record of paying dividends, and assess their future earnings potential.
Sounds like a job for a financial detective.
In a way, it is. But don't worry, we'll equip you with the tools and knowledge you need to become your own dividend detective. We'll dive into the nitty-gritty of analyzing dividend stocks later in this deep dive. For now, let's move on to our next income-generating asset: real estate. This one seems to be a popular topic.
It definitely is. It seems like everyone and their uncle has an opinion on real estate. What is it about owning property that's so alluring?
Well, for starters, it's a tangible asset. You can see it, touch it, even live in it. Unlike stocks, which exist as digital entries in your portfolio, real estate has a physical presence.
That's a good point. There's a certain sense of security that comes with owning a piece of land or a building. But is it really the golden ticket to financial freedom that some people make it out to be?
It can be, but it's not without its challenges and complexities.
That's what we want to unpack today, right? The good, the bad, and everything in between when it comes to real estate as an income-generating asset.
Precisely. Now let's start by addressing the elephant in the room: leverage.
Leverage, that word gets thrown around a lot in the real estate world. What does it actually mean, and why is it such a big deal?
Leverage is essentially using borrowed money to amplify your potential returns. In the context of real estate, it usually refers to taking out a mortgage to purchase a property.
So instead of paying for the entire property up front, you're putting down a smaller amount and borrowing the rest from a lender.
Exactly. And this is where the magic of leverage comes into play. But remember, with great power comes great responsibility.
Because if the value of the property goes up, you make more money, but if it goes down...
You guessed it, you could end up losing more than your initial investment. Leverage magnifies both profits and losses, so it's crucial to approach it with caution and a clear understanding of the risks involved.
So leverage is a double-edged sword. It can be incredibly powerful, but it's not for the faint of heart.
That's a great way to put it. And it's just one of the many factors to consider when evaluating real estate as an income-generating asset.
Okay, let's shift gears now to something that's often seen as a more stable investment: bonds. I have to admit, I was a bit surprised to read that even Warren Buffett recommends them as part of a balanced portfolio.
It's true. Even the Oracle of Omaha recognizes the value of bonds, especially as part of a long-term investment strategy.
That's fascinating. Why would someone like Warren Buffett, known for his bold investment moves, advocate for something that's often seen as less exciting than stocks?
Well, remember, investing isn't always about hitting home runs. Sometimes, a steady single or a well-executed double is all you need to win the game. Bonds are like the reliable players on your investment team, offering stability and a predictable stream of income.
Okay, I'm intrigued. Tell me more about these reliable players in the investment world. What exactly are bonds and how do they work?
In simple terms, a bond is like a loan that you give to an entity, usually a government or a corporation. When you buy a bond, you're essentially lending them money for a fixed period, and in return, they promise to pay you regular interest payments, known as coupon payments, and to repay the principal amount when the bond matures.
So it's like being the bank, only instead of lending money to individuals, we're lending it to governments and companies.
That's a great way to think about it. Now, the interest rate you earn on a bond, known as the coupon rate, is predetermined at the time of issuance. This means that, unlike stocks, where dividends can fluctuate, you know exactly how much interest income you'll receive from a bond each year.
Okay, so that's where the stability factor comes into play.
Exactly. Bonds are often seen as a safe haven, especially during times of economic uncertainty or market volatility.
That makes sense. People tend to flock to safer assets when the stock market gets a little rocky. But what about growth potential? Are bonds just a slow and steady investment, or do they offer any opportunity for significant capital appreciation?
Well, the growth potential of bonds can be a bit tricky. It's not as straightforward as stocks, where you're hoping for the share price to go up.
So how do you make money with bonds, if not from the price going up?
There are actually a couple of ways. First, you have the regular interest payments, those coupon payments we talked about. They provide a steady stream of income, which can be especially appealing to investors looking for a predictable cash flow.
Makes sense, like receiving rent from a property, but instead of a tenant, it's a government or a company paying you.
That's a great analogy. Now, the second way to potentially profit from bonds is through capital appreciation, but it's a bit more nuanced than with stocks.
Okay, I'm all ears. How does that work?
Imagine you buy a bond with a coupon rate of, say, 4%. Now, let's say interest rates in general start to decline. Suddenly, your bond, which is paying a higher interest rate than what's currently available in the market, becomes more valuable.
Because who wouldn't want a bond paying a solid 4% when everything else is offering, say, 2 or 3%?
Exactly. So in this scenario, even though the face value of your bond hasn't changed, its market value, what someone would be willing to pay for, it goes up. And if you decide to sell the bond before it matures, you could potentially make a profit from that price difference.
Interesting. So it's almost like playing the interest rate game, trying to anticipate which way they'll move.
There's definitely an element of that involved. But remember, just like with any investment, there are risks. If interest rates rise, the value of your bond could decrease.
Makes sense it would be less attractive compared to newer bonds offering higher interest rates.
Precisely. So the key takeaway here is that while bonds are often seen as a more stable investment than stocks, they're not entirely risk-free. It's all about understanding the relationship between interest rates and bond prices.
Got it. Now, I'm curious, the source mentioned something about Warren Buffett recommending a specific portfolio split between stocks and bonds, especially as people get closer to retirement. Something like 90-10, if I remember correctly.
That's right. It might seem surprising that someone as successful as Warren Buffett would advocate for such a seemingly conservative approach.
It does seem a bit counterintuitive, especially considering his reputation for making bold investment moves. What's the thinking behind that 90-10 split?
Well, it all comes down to risk tolerance and time horizon. When you're younger and further away from retirement, you have more time to recover from potential losses, so you might be more inclined to take on more risk. Hence, a higher allocation to stocks, which have historically offered higher potential returns over the long term.
But as you get older and closer to retirement, you want to protect what you've accumulated and shift towards more stable investments.
Exactly. That's where bonds come in. They can act as a buffer against market volatility and provide a more predictable income stream during retirement. Of course, the ideal asset allocation varies from person to person depending on individual circumstances, risk tolerance, and financial goals.
So the 90-10 split is more of a general guideline than a hard and fast rule.
Absolutely. It's essential to work with a financial advisor to determine the asset allocation that aligns best with your unique situation. But the key takeaway here is the importance of diversification.
Don't put all your eggs in one basket.
Yeah, exactly. By diversifying your portfolio across different asset classes, stocks, bonds, real estate, and so on, you're essentially spreading your risk and increasing your chances of achieving your financial goals.
That makes a lot of sense. Diversification, it's like the investment equivalent of a balanced diet.
I love it. Just like you wouldn't eat pizza every day for optimal health, you shouldn't rely solely on one asset class for your financial well-being.
Now, speaking of diversification, let's dive into a topic that often gets people really excited: owning a business. But not just any business. We're talking about businesses that generate income without requiring you to be there 24/7. Is that even possible? It sounds almost too good to be true.
It does, doesn't it? But it's definitely possible. That's the beauty of what we call cash-flowing businesses.
Cash-flowing businesses, tell me more.
These are businesses designed to generate a steady stream of income, even if you're not actively involved in the day-to-day operations. Think of it like owning a rental property you collect rent every month, even if you're not the one fixing leaky faucets or mowing the lawn.
Okay, that analogy makes sense. So what are some examples of these magical cash-flowing businesses?
Oh, there's a wide range out there.
Right.
Restaurants, franchises, online businesses, vending machines, you name it. If it can generate revenue with minimal owner involvement, it falls under the umbrella of a cash-flowing business.
Wow, that's quite a variety. But what makes these types of businesses so appealing, besides the obvious potential for passive income?
Well, for one, you have a level of control that you wouldn't have as a passive investor in stocks or bonds. You have a say in major business decisions and how those profits are reinvested. Plus, there's the potential for significant tax advantages.
Tax advantages always music to an investor's ears. What kind of tax benefits are we talking about here?
Business owners often have access to deductions and write-offs that aren't available to traditional employees. For instance, you can deduct business expenses, depreciation on assets, and even a portion of your home office if you have one.
So not only are you potentially earning passive income, but you're also reducing your tax burden in the process. That's a win-win.
Precisely. But of course, it's not all sunshine and roses. Owning a business, even a cash-flowing one, comes with its own set of challenges and responsibilities.
Like what? What are some potential downsides to consider before diving headfirst into the world of business ownership?
Well, for starters, even cash-flowing businesses require some level of initial investment and ongoing management. You might not be flipping burgers or coding websites yourself, but you'll likely need to hire and manage a team, handle finances, and make strategic decisions.
So it's not entirely passive income in the true sense of the word.
Not necessarily. There's usually some level of active involvement required, at least in the initial stages and during major transitions. And of course, there's always the inherent risk that comes with any business venture.
That's true. Even the most well-managed businesses can face unexpected challenges. So it's important to go into it with a realistic understanding of both the potential rewards and the risks involved.
Couldn't agree more. Thorough research, careful planning, and a solid understanding of the market are crucial for success in any business venture.
Great advice. Now, before we move on from businesses, I have to ask, what about startups? They seem to be all the rage these days, with stories of early investors striking it rich by backing the next big thing.
It's true. Startups have a certain allure, the potential for exponential growth, the excitement of being part of something groundbreaking, the dream of turning a small investment into a life-changing fortune.
It's like the Wild West of the investment world. High risk, high reward, and a whole lot of unknowns.
Yeah, it's a great way to put it. Investing in startups is definitely not for the faint of heart.
So what makes startups so risky? And on the flip side, what is it about them that attracts so much investment capital and captures the imagination of so many entrepreneurs?
Well, startups are inherently risky because they're venturing into uncharted territory.
They're like those early explorers setting sail into the unknown, hoping to discover new lands and riches.
Exactly. They're often developing brand new products or services, disrupting existing industries, and trying to create a market where there wasn't one before.
And that comes with a lot of uncertainty, right?
Absolutely. There's no guarantee that their innovative ideas will resonate with consumers, that they'll be able to outmaneuver competitors, or that they'll secure the funding they need to scale their operations.
So a lot of things have to go right for a startup to succeed.
It's true. And even then, there's always the risk that external factors, a sudden economic downturn, a global pandemic, a shift in consumer behavior, could derail their plans.
It's like navigating a minefield blindfolded. No wonder startups are considered high-risk investments.
They definitely are. But that's not to say that all startups are destined to fail. In fact, some of the most successful companies in the world today, think Apple, Amazon, Google, started out as small startups with a big dream.
That's what makes them so enticing, right? The possibility, however slim, of getting in on the ground floor of the next big thing.
It's the allure of potentially life-changing returns. But it's essential to remember that for every Amazon or Google, there are countless other startups that didn't make it.
It's like searching for a needle in a haystack, hoping to find that one diamond in the rough.
Exactly. Investing in startups is a high-stakes game, and it's not for everyone. It requires a certain appetite for risk, a long-term investment horizon, and a willingness to accept the possibility of losing your entire investment.
So it's not something to jump into lightly. Thorough research, careful due diligence, and a solid understanding of the risks involved are paramount.
Absolutely. It's essential to do your homework, understand the startup's business model, assess the experience and track record of the founding team, and carefully consider the potential risks and rewards before investing a single dollar.
Solid advice. Now, as we wrap up this deep dive into the world of income-generating assets, I think it's clear that there's no one-size-fits-all solution. The best approach depends on a variety of factors: your risk tolerance, your time horizon, your financial goals, and even your personal interests and values.
You've hit the nail on the head. Investing is a deeply personal journey, and what works for one person might not be suitable for another. The key is to approach it with a sense of curiosity, a willingness to learn, and a commitment to making informed decisions that align with your unique circumstances and aspirations.
It's about taking control of your financial future, educating yourself about the different options available, and building a portfolio that reflects your individual goals and values.
Beautifully said. It's not just about chasing the highest returns or following the latest investment fads. It's about crafting a financial strategy that empowers you to live a life you love, both today and in the years to come.
And on that empowering note, we've reached the end of our deep dive into the world of income-generating assets. We hope this exploration has sparked your curiosity, equipped you with valuable insights, and inspired you to take charge of your financial well-being. Remember, the journey to financial freedom starts with a single step and a commitment to lifelong learning. Keep exploring, keep asking questions, and most importantly, keep diving deeper. Until next time, happy investing.